Welcome to the Motley Fool's Crunchtime series, where we scout out a single company from the story to the opportunities and risks. Time to talk Disney. I'll start with my prediction. I think Disney will roughly perform with the market over the next 5 years. Let's talk about why. We're going to start with business strategy. Disney's business is built around monetizing a massive collection of some of the most popular, well-loved, and valuable entertainment properties on Earth. It does that across just about every medium, including linear TV, streaming, theaters, toys, games, collectibles, theme parks and resorts, and cruise lines. The opportunity for Disney, that's twofold. First, there is a lot of global growth potential. Continue expanding its media empire, especially developing and acquiring local language content in global markets to grow the streaming business. It also has a lot of room to grow and expand its in-person, experiential, and hospitality operations. It already has plans in place to expand all of its global theme parks and to more than double the size of its cruise ship fleet in coming years. But to get the best out of that growth, Disney has to continue navigating the shifting media landscape. It is steadily making more content available via streaming. It recently added Hulu access through the Disney Plus app, has plans to add an ESPN tile later this year and make even more ESPN content available directly to people that don't have a cable subscription sometime in 2025. As more people make the shift to streaming, Disney is positioning itself to win those customers. Of course, there are risks. Disney has made big progress since Bob Iger came back. Its studio business is bouncing back with a record 2024. Its streaming segment is rocketing from billion-dollar losses just a few years ago to what looks like billions of dollars in operating profits as soon as next year. The problem? Some of those gains, they're coming at what will likely continue to be the expense of its linear TV business. Cord cutting and cord nevers likely going to cause that business to continue to decline over the long term. Disney's hardest job is turning what could be a zero-sum transition into a net positive on its bottom line. It also faces an uncertain leadership future. A new board chair takes over in January. Bob Iger's eventual second predecessor still hasn't been found. We've seen how important the person sitting in the big chair at the House of Mouse can be, too. As much as anything, this is my biggest concern about Disney's ability to beat the market over the long term. All right, let's wrap things up here. I love Disney, and there's no arguing its place on the top of the entertainment world. But what's less clear is whether the massive success we saw under Iger's first tenure or the turnaround in his second act will continue when a successor takes over for a second time. With the stock trading already for a lofty 26 times free cash flow, expectations are really high. As much as I want to pull for Disney the stock, I think the expectations are a bit too high based on the realities the business faces and that valuation. I think Disney will probably be a fine investment, but if you're looking for a market beater, I would look elsewhere right now. Not the Motley Fool, your comments make us smarter. Please comment with your own research and insights about Disney. Also, tell us what stock you'd like to see us tackle next. Go to fool.com/invest to receive the top 10 best stocks to buy now.